Hi, my name is Bert Nussbaumer from macrobeat.co.uk. Finally, we had a bit of action yesterday in the FX market. It was a long time coming. A combination of the stronger ADP, a higher revision in unit labor costs, solid PMI, solid ISMs, really started to reignite this sort of little taper tantrum. We didn't see much on the yield side, but the dollar did really react rather strongly. I guess the market starts to sort of realize that the window around the Fed might actually be closing. Not that we have a really firm timeline in mind, but I think the market does really start to understand inflation is incoming. Every sort of data we look at, I think that unit labor cost did really sort of shake up things a little bit yesterday. And I think this is really what the market is going to focus now. Yes, transitory is out there, and even myself that really is looking for these kind of moves understand that some element of it is definitely transitory. We agree on that. I just think there's maybe two issues now out there for the market to sort of talk about or think about. One is, what does transitory actually mean? If you ask me, at first you would think 3 to 6 months. What if the transitory is actually 12 months or more, which I think the market might actually no longer buy into the Fed strategy. The second thing obviously would be, we don't know where the peak is going to be in core inflation. And what if the transitory element is really only bringing inflation down to 2.5%? That obviously would be another issue. Definitely the June meeting is off, but I would think that it's probably interesting to see what individual Fed members would be saying. Not that I expect a taper word or whatever, but maybe just a slight twist, which for me would still keep the summer Jackson Hole firmly on the agenda. I wouldn't be surprised if Mr. Powell would actually announce that the September meeting is live. That alone would really be enough to get things going. Obviously, we have non-farm payrolls today. So after the big dollar move yesterday, we obviously need the confirmation of better employment data. Generally, I would expect a rather strong one given the disappointment last time, but we still talk a lot about staff shortages out there, businesses that are looking for staff, and staff just not willing to come back to work while these sort of government employment support programs are running. So that leaves us still with a little bit of downside risk that the full truth of the recovery may not be visible. I just hope the market is clever enough to understand that this has nothing to do with the recovery and more to do with maybe it's time to end those sort of support programs. I have a few charts for you today. The first slide obviously is what we just talked about. We have the sort of sharp or new record of job openings versus still a sort of sluggish picking up on jobs. So that sort of red and green divergence you see here is definitely what could be some downside risk to the non-farm payroll. On the next slide, we have euro dollar. That's really the push lower in euro yesterday, or the dollar rally. We've sort of taken out the recent May rally, and we just start to sort of look at the sort of pivot area here around 121, where in a sort of solid payroll data, we should actually see a continuation of this move. Next chart here, I've chosen the daily one. That's the Aussie dollar, 76.75. That has been the floor for many weeks now. We moved below that level yesterday. If we can stay below that level into the weekly close, I would actually think the Aussie basically signals that it's ready to roll over, and we could head towards 75 and even 74 in the weeks ahead. On the next chart, that's a CNH. Obviously the big story this week, we had this huge break of 640 level, which was seen a really big leg down to 635, a lot of excitement. It sort of led to broader dollar weakness, but the PBOC was very fast in coming back to actually stop the excitement right away and already commented they're going to slow down the move. So that sort of story seems to have gone away quicker than we expected. The next slide, this is gold. We have really the this is the strong leg down on the back of the dollar rally. We have sort of broken the mid-daily Bollinger Band. 1858 is the FIBA support here. A break would really be an issue for gold. The ADX, the indicator, the momentum indicator, is turning as well. So only a weak non-farm payroll could really save gold. With a strong one, I think gold has a lot to fall and could really see 1800 or lower. That's it from me. Thanks very much.